Wondering what a balance sheet is and wondering how you read the thing? Well, you're in the right place. As a business accountant, my team and I spend all day long helping business owners on their journey, and of course, explaining to people how to read financial documents is a key part of what we do. And one of these particular documents, the balance sheet, is quite often just overlooked as something that is not really meaningful, doesn't really mean anything, but I want to show you why it's really important to your business. And just a couple of practical tips for things to look for and how you can kind of just understand what it's all about. So before we get into that, if you like these type of videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. So the balance sheet then, what is it? Well, basically it's a document that shows you the financial position of the business at any moment in time. So when you see the date on there, it's kind of a snapshot at that date of the overall kind of health and situation of your business. I like it as kind of an inventory, I suppose, of what your business owns and owes and everything else. And I quite often refer to it and explain it as the good, the bad, and the hopefully not ugly. Now, I'll explain that as we go with a couple of screenshots so you can see. I'm going to try and keep this really top level and short. It's more about you gaining an awareness of what you're looking at and understanding what some of these things mean. Now, firstly, it's worth saying that I'm talking to you as if you've got this on tap. So if you're inside of a Xero or a QuickBooks or one of these accounting apps, you can literally go to kind of reports and find this document called a balance sheet in there. It will bring it up instantly for you, and then hopefully you can go dig through it. If you haven't, you might be looking at a set of accounts that your accountant's produced for you or someone else has produced for you, and you might need to then go and ask them for certain balances and breakdowns. If some of these things I'm going to say to you, oh, well, go check this. Obviously on a bit of paper or a PDF, you're not going to be able to click in, but in the apps, you'll certainly be able to click in and see the detail. So then I've told you what a balance sheet is overall. It's that financial position of the business, the kind of health and inventory of the business, not to be confused with inventory like the stock you might have, but I like to think of it as like an overall inventory. So the way it works is that the good, the top half of this balance sheet. So here's an example. This is the good part of the good part of the balance sheet. It's all the stuff you kind of own. So it might be your plant and machinery, so you're like your computer equipment for a lot of businesses that are listening to this, and other things that the company owns. And you'll notice it's not market value, so it's not actually what you'd pay for it now if you went and sold it on the open market. The way the accounting standards work is that it's based around cost of what it cost you, and then you'll see in your accounts sometimes over time it's all written off and written down. So that's kind of your assets as it's known. And then you'll be other kind of assets like cash. It will show you cash balances in your banks, and it will show you if people owe you money, and this is quite a big area. So when you're first looking at it, a couple of things to highlight there is to make sure that you're looking at it and thinking, are these balances right? You should probably know at that date what your bank balance is, or you can at least look on your app. And if that's wrong, that's worth digging into either with the person producing it or for you, if you're doing your own bookkeeping, trying to figure out why that's not showing correctly in your bookkeeping. That's a nice awareness piece there. But one of the most important ones, if you send invoices, of course, is the trade debtors, as it's known, or accounts receivable. You might see it linked, one of those terms. All that is all the people, that's the total value of money that you're owed at that date that people haven't paid you in invoices. So if you go to an accounts receivable summary or a trade debtors, there'll be a report inside of your software, depending on what you're using, and it will show you per customer at that moment in time who owes you what. And then you can take some action. You can go chase those invoices, you could write them off, or you might decide that actually it's all really wrong and there's something going on with your bookkeeping, and again you can go figure out what's happening there. So that's quite an important figure and a good area to look at. That's kind of what I call your inventory, having a look, what's the good stuff we've got. Now the way the balance sheet works is when you've got that good stuff, if you then take off the bad, so this bit, what's left is going to be the final section I'm going to look at, which is the hopefully not so ugly section. So in the bad section, you've got all the things that you might deem as bad, like loans you might have to repay in the future, future tax bills, those kind of things. It might be that some things in there can be good, like there might be, if there's a positive balance in that section for direct loan account, it means you're owed some money back from the company, so that's kind of a positive thing. But in reality, from the company's viewpoint, it's still money owed to somebody else. So it gives you an idea, and it's worth remembering that it doesn't mean that at this moment in time all of that's due, but it's the overall position. It means, you'll see it often where someone will have a bank loan. Okay, they've got plenty of cash to keep repaying that loan, but if you look at it as an overall position, it might not read as well because there's this big loan that's eventually due back, and we don't know how much money the company's going to generate. So the idea is really, if you looked at it, if you took the good and took the bad off of it, you end up with this hopefully not bad bit. And the reason I say hopefully not bad is because you don't want it to be a minus figure. So this hopefully not bad area here is really the breakdown of what money, if you shut it down that day and you actually got money for all those assets, that, like your computer equipment and things, at the value it says, which is why it's very rough. It's unlikely that would be the case, but let's just say it was, and you recovered every penny that you owed, and you had all that bank in the all that cash in the bank, and then you paid off all your loans and all your future tax and everything else, in theory what's left is that bottom figure, that bit referred to as like total capital and reserves. You might also see it in a limited company listed as like shareholders funds. So that there is really kind of your money that's left at the end of it at that moment in time. So in theory, if you shut it down today, in very rough theory, but really, really rough, if you shut it down on that day, that's the kind of money that would be left. And I think it's a really good thing to look at, because obviously you want that value to go up, but also it's okay for it to come down, because it will come down when you do things like pay yourself dividends or draw money from your sole trader business. That's you taking money out, that money is going to come down, but it's having an awareness that that's there. And really, you don't want it to be in a negative. As in a negative, you've got to really think about, okay, am I okay with the business? Is it going the right way? And in early startups, sometimes when you're making a loss, that is quite common that it is negative. So just understanding what that means, why it's negative, and whether you're okay with it, whether you're legally okay with it as well. And obviously reach out for some help to people if you need some help thinking about what to do about that if it's in a problem. Because for those of you paying dividends out of your limited company, that being in a minus is a problem, because in theory then there's no money in the business left, so you can't pay yourself dividends. It's these kind of things. So that's quite important for you as an owner to understand that figure wants to be positive. If it's not positive, then there's an indication something's not going as well as you'd hope. And I think in that final area, the thing to look at really quite often is that owner's drawings or those dividends paid type figures, because at least you get an appreciation then, especially if you're not doing the bookkeeping or you're not declaring the dividends. It's worth just understanding what's gone into that balance. Why have I really taken that amount of money? That's a very common question from clients. Have I really taken that money? Yeah, unfortunately you have, but clicking into there will really help. And again, awareness piece, have a look at, particularly with the bad side of it, having a look at who do I owe money to, and really just understanding that total debt, that you might, and that's quite normal in businesses, is to, take on some debt as you grow. You might need it for growth and things like that. Or, you've just had a loan from a family member. It's a nice reminder of what you've got to pay them back. So take that sort of bad inventory as well as the good, and look at the overall position in your business and think, is this going the way I want and I'm happy with it? And then you can make further decisions from there. But in this video, I just want you to have that awareness and that confidence to read it and look. But if any of those balances as you go through don't look right, you don't think, well, no, I don't owe that loan, or no, that client doesn't own that invoice. If you're doing the bookkeeping, that's something to dig into. If somebody else has prepared it for you, check in with them, ask them for a breakdown, talk to them about it, because it might be they were just unaware of it or they've just got it wrong. So definitely have those conversations. So there you go. That's a very, very brief overview of how to understand and read a balance sheet. I'm sure we'll do some more videos on this topic in the future, digging in a little bit more. We'll see you on the next one.